If you're 60 or older and you own a home in California, the state has quietly handed you one of the most powerful financial lifelines it has ever offered senior homeowners. And the painful truth is that most people who qualify have absolutely no idea these programs exist. Property taxes have been crushing seniors on fixed incomes for decades. We're talking about men and women who worked their entire lives, paid off their mortgages, built equity in their homes over 30, 40, even 50 years, only to find themselves trapped between rising tax bills and retirement incomes that simply cannot keep pace. Some have been forced to sell the homes they raised their children in, not because they wanted to, not because they had to move, but simply because the tax bill became impossible to pay. That is not how it's supposed to work. And California, to its credit, has responded. Over the past several years, California has dramatically expanded its property tax relief programs for senior homeowners. New transfer rights, state-funded postponement options, local county exemptions, and disaster relief provisions. Together, these create a layered system of protection that, when stacked together, can save qualifying seniors, thousands of dollars every single year. The problem isn't that these protections don't exist. The problem is that the government is not exactly sending you a personal letter explaining all of this. There's no reminder, no automatic enrollment, no alert when you qualify. If you don't go looking, you will never find it. That's exactly why we're here today. At Smart Law Wallet, our entire mission is to translate complicated California law into clear, actionable information that you can actually use. This video is going to walk you through every major property tax relief program available to California seniors right now. What changed? Who qualifies? Exactly how the math works. And most importantly, what deadlines you cannot afford to miss. By the time this video is over, you'll know more about your own property tax rights than most accountants and real estate agents in this state. Let's get into it. Section 1, what California actually changed. Proposition 19, and what it means for you. The foundation of everything that changed for senior homeowners begins with Proposition 19. California voters approved it in November of 2020. It took effect on April 1st, 2021. To truly understand how significant this change was, you need to understand what life looked like before it passed. Before Proposition 19, California had a program that allowed senior homeowners to transfer their existing low property tax assessed value to a new home. But the restrictions were so tight that the benefit was nearly useless for most people. You could only transfer your assessed base to a home within the same county. If you lived in San Francisco and wanted to retire to a smaller, more affordable home in Fresno or San Diego or Sacramento, you couldn't take your low tax base with you. You'd lose decades of Proposition 13 protection the moment you crossed a county line. On top of that, you could only make this transfer once in your entire lifetime. One move, one chance, one county. For a state as large and geographically diverse as California, those restrictions effectively meant that many seniors simply didn't move at all. Not because they were happy where they were, but because moving would have been financially devastating. Proposition 19 eliminated both of those restrictions completely. Now, California homeowners who are 55 years of age or older can transfer their existing property tax assessed value to a replacement home anywhere in the state, any county, any city, and they can do this up to 3 times during their lifetime, not just once. That is a seismic shift in the financial math of retirement for millions of California homeowners. Let's look at what that means in real dollars, so this doesn't stay abstract. Imagine you've owned your Los Angeles home since 1992. The county assessor has your home assessed at $280,000 because that's roughly what it was worth when Proposition 13 locked in your base, adjusted for the modest annual increases allowed under that law. Today, that same home has a market value of $950,000. You want to downsize? You find a smaller, more manageable home in Riverside County that costs $620,000. Under the old rules, you'd have to choose between staying in your too large home or paying property taxes on the $620,000 purchase price. Under Proposition 19, you carry your $280,000 assessed base to that Riverside home. Your property taxes are calculated on $280,000, not $620,000. At California's standard 1% property tax rate, that's $2,800 per year instead of $6,200 per year. A savings of $3,400 every single year. For as long as you own that replacement home, over a 10-year retirement, that's $34,000 back in your pocket from a single provision of California law that most homeowners have never heard of. This benefit is authorized under California Revenue and Taxation Code, Section 69.5, as amended by Proposition 19. To claim it, you file Form BOE 19B directly with the county assessor's office in the county where your new replacement home is located. And you must do so within 3 years of purchasing that replacement property. Section 2. Understanding the base year value transfer. I know the exact math you need to know. To fully take advantage of what Proposition 19 offers, you need a solid understanding of how California calculates property taxes in the first place. And that means going back to the law that started it all, Proposition 13, which California voters passed in June of 1978. Under Proposition 13, which is written directly into the California Constitution under Article 13A, property taxes are set at 1% of the assessed value of your home. That assessed value is locked in at the price you paid when you purchased the property. And it can increase by no more than 2% per year, regardless of what the actual and the replacement cost. So here's an example. You sold your original home for $800,000. California Revenue and Taxation Code, Section 69.5B3, defines this as a person who has a severe and permanent physical disability that prevents them from engaging in any. Every single senior property tax program discussed in this video rests on the foundation of Proposition 13. You cannot fully understand what you're entitled to without understanding how Proposition 13 works, and more importantly, how durable its protections actually are. California voters passed Proposition 13 in June of 1978, and it immediately became part of the California Constitution under Article 13A. The law accomplished 3 things simultaneously. It capped annual property taxes at 1% of assessed value statewide. It rolled back assessed values to their 1975 to 1976 levels for all existing homeowners. and it restricted future annual increases in assessed value to no more than 2%, no, completely disconnected from whatever the real estate market is actually doing in any given year. The cumulative effect of that 2% cap over decades is staggering in a state where real estate values have climbed the way California's has. If your parents purchased a home in Pasadena in 1980 for $140,000, that home's assessed value today, after 45 years of the maximum 2% annual increase, is approximately $335,000. The actual market value of that same home is probably somewhere north of 1.1 million. And in some Pasadena neighborhoods, significantly more. Under Proposition 13, your parents pay property taxes based on $335,000, roughly $3,250 per year. Without Proposition 13's protection, they'd owe taxes on the full $1.1 million market value, which would be approximately $11,000 per year. That's a savings of $7,650 every single year. Not from any program they had to apply for, not from any benefit they had to earn, but simply from the passive ongoing protection of a constitutional law. You must meet all of the following conditions. You must be 62 years of age or older, or be blind, or have a qualifying disability, as defined under the program's guidelines. Your total household income from all sources, Social Security, pension, investment income, everything must be at or below $51,160. That is the 2024 income threshold, and it is adjusted annually for inflation. So always verify the current figure at skio.ca.gov before applying. You must have at least 40% equity in your home, meaning you cannot owe more than 60% of the home's current assessed value across all mortgages and liens combined. The home must be your primary residence, not a rental, not a second property. And you cannot have a reverse mortgage on the property. If you meet every one of those conditions, here's what actually happens. The state pays your county property tax bill in full for that year. The amount paid becomes a lien on your property, accruing simple interest at 7% per year. There is no monthly payment. There is no balloon payment due at any arbitrary date. There is no deadline that forces you to repay while you remain living in the home. The only triggers for repayment are the ones already mentioned: sale, refinance, title transfer, death, or change of primary residency. For a senior in Sacramento or Stockton who is paying $5,000 or $6,000 a year in property taxes on a fixed Social Security income, this program can completely eliminate that annual financial burden. The application window for this program opens every October and closes in February of the following year. Applications are submitted online or by mail through the State Controller's Office at SEOCA.gov. Missing that window means waiting an entire calendar year to apply again. Section 6. Local county programs, the extra layer most seniors never claim. On top of every state-level program covered in this video, California counties are authorized by law to create their own additional senior property tax relief programs, and many of them have done exactly that. The problem is that these programs are not aggressively advertised, and your county assessor's office is under no legal obligation to personally notify you that you might qualify. You have to go looking. And most seniors never do. Start with the basic homeowner's exemption, which is available to every California homeowner under California Revenue and Taxation Code, Section 218. This exemption reduces your home's assessed value by $7,000, cutting your annual tax bill by $70. That's a modest number. But the important thing is that it's permanent once you file. And you only need to file once using Form BOE 266 with your county assessor. It takes 15 minutes. And it saves you money every year, indefinitely. Beyond that baseline exemption, individual counties have created significantly more generous programs. San Francisco operates a senior exemption for homeowners who are 65 years of age or older that can reduce assessed value by up to $80,000, provided your household income falls below the program's income ceiling. That exemption alone saves qualifying San Francisco seniors $800 per year on top of every other protection they're already receiving. Santa Clara County operates a similar program with its own income thresholds and 13 assessed value indefinitely and without condition. The child didn't need to live in the home. There was no cap on the value difference. A child could inherit a $2 million home with a $200,000 assessed base, rent it out, and pay taxes on that $200,000 base forever. That era is over. Proposition 19 changed both of those conditions, and the changes were significant. Under California Revenue and Taxation Code Section 63.2, which took effect February 16, 2021, an inherited home now only retains the parent's low assessed value if the inheriting child establishes it as their own primary residence within 1 year of the date of transfer. If the child does not move in and use it as their primary home within that 1 year window, the property is fully reassessed at current market value, potentially triggering an enormous tax increase that makes the property financially untenable to hold. Even when the child does move in on time, there is now a $1 million cap on the exclusion itself. Here is how that cap works in practice. If the home's market value at the time of inheritance exceeds the parent's assessed value by more than $1 million, the child's new assessed value is the market value minus $1 million, not the parent's original base. So if the parent's assessed base was $300,000 and the home's market value at the time of death is $1.8 million, the gap is $1.5 million, which exceeds the cap. The child's new assessed value becomes $1.8 million minus $1 million, which is $800,000, not the parent's $300,000. The annual tax difference is roughly $5,000 per year. Every year, for as long as the child owns the home. In high-cost counties like Marin, Santa Barbara, San Mateo, or Los Altos, this scenario plays out constantly and catches families completely off guard. If you own a high-value home and you want to protect your children from this outcome, the time to act is now, while you are healthy and your options are open. A California estate planning attorney with specific experience in property tax law can walk you through strategies that may still be available, but none of those strategies exist after the fact. Once you're gone, the options are gone with you. Section 8, disaster relief property tax provisions, like what Los Angeles homeowners need right now. California law includes specific property tax protections for homeowners whose properties are damaged or destroyed by disasters. And given what happened across Los Angeles County, in January of 2025, this section applies to a very large number of people in this state right now. Under California Revenue and Taxation Code, Section 170, if your property suffers physical damage or destruction caused by what the law calls a misfortune or calamity, and which explicitly includes wildfires, earthquakes, floods, and other disasters, you can apply for a temporary reduction in your assessed value to reflect the damaged condition of the property. To qualify, the damage must equal $10,000 or more in current market value loss. You must file a written application with your county assessor within 12 months of the date the damage occurred. The assessor then reduces your assessed value accordingly. Once the property is repaired or rebuilt, the assessed value is restored to what it was before the disaster, since under Proposition 13 rules, not to some inflated new market value based on reconstruction costs. A wildfire victim who rebuilds does not get treated like a brand new buyer. Their pre-disaster base is preserved. For wildfire victims specifically, there is an additional and critically important layer of protection. If you lost your primary residence in a governor-declared disaster and you purchase a replacement home anywhere in California, you qualify for the Proposition 19 base year value transfer with absolutely no age requirement. You carry your previous assessed value to your new home, regardless of where you are in life. You file Form BOE 19D with the county assessor where the replacement property is located. Los Angeles County, Ventura County, and other affected counties have designated staff specifically for disaster-related property tax claims, and they are equipped to handle these applications now. Do not wait. The filing deadlines under Revenue and Taxation Code Section 170 are firm. And no one will call you break. Time 0.3 is in to remind you. Section 9. Deadlines and application steps only every date. You cannot miss. Every benefit covered in this video requires you to take deliberate action. Not one of them applies automatically. Here is a clear breakdown of the key dates and steps, and organized so you can put them in your calendar today. For the Proposition 19 base year value transfer, you must file your claim with the county assessor of the county where your replacement property is located within 3 years of purchasing that replacement property, or before you transfer or sell the replacement property, whichever comes first. Use Form BOE 19B for age or disability claims, and Form BOE 19D for disaster victims. Both forms are available at the California State Board of Equalization's website at boe.ca.gov. For the Property Tax Postponement Program through the State Controller's Office, the application window opens every October and closes in February of the following year. The 2025 to 2026 window will open in October 2025. Visit sqoca.gov to apply to and to confirm the current year's income threshold. For the basic homeowners exemption, you must file Form BOE 266 with your county assessor by February 15th to receive the full exemption for that tax year. If you file between February 16th and December 10th, you receive an 80% partial exemption. File after December 10th, and you receive nothing for that year. For local county senior programs, deadlines vary by county and by year, but most fall between April and June. Call your county assessor's office each January to confirm the current deadline before you miss it. California property taxes are paid in 2 installments. The first is due November 1st and becomes delinquent after December 10th. The second is due February 1st and becomes delinquent after April 10th. Under California Revenue and Taxation Code Section 2617, a 10% penalty applies to any payment received after the delinquency date. If you're enrolled in the postponement program, the state handles these payments for you. If you're not, set calendar reminders for December 10th and April 10th, without exception. Section 10. What's coming in 2025 and 2026, the legislative landscape for senior property tax relief. California's state legislature is actively debating additional expansions to senior property tax relief. And the political environment in Sacramento is currently more favorable to these changes than it has been in many years. Several assembly bills introduced during the 2025 legislative session propose raising the income threshold for the property tax postponement program above its current $51,162 cap, which would extend eligibility to middle-income seniors who currently earn too much to qualify, but still struggle under the weight of rising property tax bills. Other proposals would expand the number of Proposition 19 base year value transfers a homeowner can make from 3 lifetime uses to an unlimited number for homeowners above a certain age or below a certain income threshold. None of these proposals have been signed into law as of this recording, but the direction is unmistakable. The combination of the January 2025 Los Angeles wildfires, decades of rising property values, pushing more seniors into financial stress, and a growing and politically active senior voter population has created real and sustained pressure on Sacramento to act. Every session, the conversation moves a little further in the direction of expanded who have no idea these programs exist and who are quietly overpaying their property taxes year after year. Share it with your parents, your neighbors, your friends, your siblings. A single share could genuinely save someone thousands of dollars. At Smart Law Wallet, this is exactly what we do every week. We break down the California laws that directly impact your money, your home, and your rights. And we explain them in plain language that anyone can understand and act on. Subscribe so you don't miss a single video. And drop your county in the comments below. We read every single one, and we'll tell you which specific programs are most likely to apply to where you live. The protections are real. The savings are real. The only variable is whether you act on them.